Hello, everyone. Welcome to our fourth and final tax workshop of this session. We are going to talk about consumption taxes today. And I continue to be very grateful to the team from JFO and Legislative Council for carrying these out. They will be available on our committee website forevermore, and I encourage you to share them with your colleagues if you have a chance to view them yourself. And as with our other workshops, we'll do questions at the end.
Thank you. So my name is Abby Shepard. I'm with the Office of Legislative Counsel. I will be going over the legal background and a few of the recent legal developments in two types of consumption taxes. I'll just be touching on sales and use tax and the meals and rooms tax. There are other consumption taxes in Vermont, but that won't be covered today. So starting with sales and use tax, I will present the structure of this tax, how remote sellers are treated under recent case development, as well as Vermont's legislative response, and also touching on sort of the expansion beyond remote sellers into the marketplace facilitator area, and those are more of the recent developments. So the structure of the sales and use tax is a tax base that is retail sales, typically of tangible personal property. And then there are also other listed, so enumerated in statute charges or services that are subject to sales and use tax. You see the statutory citation there, 9771 in Title 32. So that is your tax base that is subject to the tax. And then there are many, many exemptions within Title 32, Chapter 233 on sales and use tax. And those are based on the type of good, the purchaser, the seller, the transaction, or the use. So there's a very broad array of types of exemptions from the sales and use tax. Vermont's statewide rate is a flat 6%, and the tax liability is on the final purchaser. Again, just to really focus on who is paying and how they're paying, it is paid by the purchaser at the point of retail sales. So this is not like a typical excise tax that would apply at wholesale. This applies on and to the final purchaser who pays the tax when they buy their good or pay for their services. This is also often referred to as a trust tax. So it is collected by the seller and held in trust on behalf of the state. The seller is made liable for remitting the tax collected to the Department of Taxes. So sometimes you'll see reference to a taxpayer, and that does actually apply to the seller because they are liable to collect and remit the tax. However, it is, again, being paid by the purchaser, not the seller. I've distinguished between sales tax and use tax because sales tax is paid on sales made in the state of Vermont. Use tax is paid on retail sales made outside of the state, but where the product is brought into the state for use in the state. There is this 6% sales and use tax. Some municipalities have voted to impose an additional 1% local option tax on retail sales. So those follow all of the same definitions and rules that apply to state sales tax. And municipalities can enact that into law through their charter, which then requires legislative approval. So that's the basic structure. And again, I'm happy to take questions at the end. I will pause after the sales tax portion before I move into the meals and rooms tax portion in case you have any questions. So with remote sellers, this has been the area with really the biggest impact and the most both judicial and legislative action in the last decade related to, really more than that, 30 years even, relating to sales tax. So remote sellers, the way that sales tax has treated them is subject to certain constitutional limits. Under the US Constitution, the Commerce Clause reserves to Congress, reserves to the US Congress the power to regulate trade or interstate commerce among the states. So that is a power that's reserved to the federal government. States are not permitted under the US Constitution to regulate interstate commerce. A state cannot tax goods in interstate commerce, so between states, in a way that either discriminates against that commerce in between states or that imposes an undue burden on interstate commerce. In 1992, the US Supreme Court considered a case from North Dakota. It was an office supply company called Quill that challenged a North Dakota law. Quill was soliciting and selling goods in the state of North Dakota through catalog sales, so at that time by US mail. However, Quill did not have a physical presence in the state. North Dakota sued Quill to collect and remit for goods that were purchased for use in the state. The US Supreme Court found that under the Commerce Clause, a state cannot force a seller to collect and remit unless that seller has a physical presence within the state. So as online retail sales grew, this meant that online retailers who did not have a physical presence in a state were not obligated to collect and remit sales tax in states where they weren't physically located. So this created, as online sales grew, this created a competitive advantage for online sellers who were not physically located in a state, whereas brick and mortar sellers in a state were required under the Quill precedent to collect and remit sales tax. So that was the state of the law from 1992 until 2018. South Dakota enacted a law in 2016 to challenge the Quill precedent, and it went up through their court system until it reached the US Supreme Court. And that law required any vendor, regardless of the physical presence, so that was directly targeting the Quill precedent, regardless of a seller's physical presence in the state, they would be required to collect and remit state sales tax if they had goods or services being delivered into the state that were more than $1,000 in value of this for the sales, or more than 200 individual transactions. Yes, sure. It's $100,000 of sales. So that was an either or, so it's either the value of the sales or the number of transactions. Online retailers, including Wayfair, sued to invalidate the law because it was directly conflicting with Quill, with the 1992 precedent. However, the US Supreme Court did take that case and overruled the Quill precedent, saying that the physical presence requirement was incorrect and unsound. So the Supreme Court concluded that the South Dakota law created an economic presence test that was not an undue burden on sellers. And if you remember, that's the Commerce Clause requirement, one of them. So states cannot create undue burdens on interstate commerce. US Supreme Court said by having this threshold, South Dakota was not violating that constitutional requirement because that excluded smaller vendors. Additionally, the court specifically noted that South Dakota was a member state of a multi-state agreement called the Streamlined Sales and Use Tax Agreement, and that reduces compliance burdens on sellers. Vermont is also a member state of this agreement. It creates uniform definitions for states to enact into their laws, which does reduce the compliance requirements for sellers because they can follow one single definition across states. So the US Supreme Court found that this economic presence test created a safe harbor, and that a state law, as long as it has this economic presence requirement, does comply with the Commerce Clause. So that was in 2018. Vermont was well aware of the South Dakota law that was enacted to challenge the Quill precedent. So in 2016, Vermont enacted an identical economic presence test requirement of the $100,000 of sales or 200 or more transactions into the state, and created a contingent effective date so that on the first day of the first quarter after the US Supreme Court overruled Quill or US Congress enacted federal legislation repealing the physical presence requirement, then Vermont's law would take effect. So once Wayfair was issued by the US Supreme Court, Vermont's contingent effective date took effect, so it triggered this law saying sellers have to collect in Vermont and remit Vermont sales tax, even if they don't have a physical presence in the state. And you'll see I did note, since 2007, Vermont has been a member of the Streamlined Agreement, where you have these uniform definitions. So that is one of those factors that the US Supreme Court pointed to as an economic presence test and not having an undue burden on smaller sellers. There are a few ways that Vermont has taken action to have a constitutionally valid seller collection and remittance requirement. Okay, so just to reiterate, Vermont has had this collection requirement since July 1st of 2018. So Wayfair allowed Vermont to collect and remit on certain sales by vendors who are not physically present. However, there were other sellers making online sales that were not captured by this new sort of Wayfair triggered law. And one example of a marketplace facilitator that I'm sure everyone is aware of is Amazon. They have a platform from which third-party sellers can make sales online. So just after the Wayfair decision was handed down and Vermont's law took effect, it became apparent that marketplace facilitators were not being captured within that law. Captured is maybe not the right word. Weren't subject to that law, so they were not collecting and remitting for their third-party sales. As a result, in 2019, Vermont enacted a marketplace facilitator law. It has that same economic presence as opposed to a physical presence requirement of $100,000 of sales or 200 or more transactions in the preceding month. This means that marketplace facilitators who have a platform where third parties are selling into Vermont, those facilitators are now also subject to collection and remittance requirements. Okay, so that is the extent of the presentation on consumption taxes as it relates to sales and use tax. If there are any questions about the sales tax portion, I'd be happy to take them now, or I'll move on to the meals and rooms tax. Okay. So moving on to meals and rooms tax. So this will have a similar structure as the sales and use tax presentation. I'll talk briefly about the structure, who it applies to, and what transactions are exempt, and the recent changes that have been made. This is more within legislation rather than any case law. So the meals and rooms tax applies to, so it's actually two tax types that are applying to different tax bases. So you have occupancy or rent, that's what rooms tax applies to, or a taxable meal, which meals tax applies to. They're all within the same chapter within Title 32. That is also where the alcoholic beverages tax applies. That is not discussed in much detail in this presentation. The meals and rooms tax structure, that's a 9% rate, whereas the alcoholic beverages tax is a 10% rate. Again, this is very similar to the sales and use tax in that the tax liability falls on the occupant or the person consuming a meal, so it's the final sale that is subject to tax. Tax is collected, so again, this is a trust tax. It's collected by the restaurant if it's meals and rooms tax, or an operator if it's the rooms tax. It's collected at the point of sale, and it's held in trust for the state and then remitted to the state by the seller, the restaurant or the operator. So again, the tax liability is statutorily imposed on that restaurant or operator. They are also referred to in the chapter occasionally as the taxpayer because they have the liability to remit to the department. This also applies statewide, and there is also a 1% local option tax that can be applied if municipalities vote to impose it, and then needs to have further legislative approval. Diving in slightly to what constitutes a taxable meal, and then I'll touch briefly on what is a taxable, what's a taxable occupancy or taxable rent for the meals tax purposes. A taxable meal, there's a very lengthy and complex definition in statute setting out what constitutes a taxable meal. The general rule is that any food or beverage sold by a restaurant for consumption either on or off premises is subject to tax. Then you get into all of the different ways that we buy and consume food. So the definition of taxable meal sets out different ways that food or beverage is considered taxable. Food or beverage, when it's not sold by a restaurant and not prepackaged, is taxable, whether, again, it is being consumed on or off premises. So that gets at takeout or delivery of meals as well. Also taxable, and it does not matter whether or not it is prepackaged. There's a list of types of food that are always taxable listed here. Sandwiches of any kind except when they're frozen, food or beverage furnished from a salad bar, any heated food or beverage, and food or beverage sold through a vending machine. They aren't drafted within the language. The language does not create exemptions. They are rather exclusions from this definition of taxable meal. And there are many based on the purchaser, the seller, or the item itself. One example is meals served on a summer camp for children, on the premises of a summer camp for children. There are two different exemptions for nonprofits that have their own conditions. So each of these has some complexity to them. In terms of the rooms tax, that's a taxable occupancy is the tax base that the 9% rooms tax applies to. And rooms tax is due on rent charged for use or possession of sleeping accommodations that are offered to the public for a consideration. Consideration is a legal term for charge, so any money that is paid. So if it were a free sleeping accommodations arrangement, it would not be subject to tax. This does not include any occupancy by what this chapter defines as a permanent resident, which means someone who is occupying sleeping accommodations for at least 30 consecutive days. So a renter who is who is occupying a room or other sleeping accommodations for at least 30 consecutive days is not subject to this tax. It does not include employees of an operator when those sleeping arrangements are a type of compensation for their employment. And again, the summer camp for children example, the rooms tax does not apply to any occupancy provided to children in summer camps. So some of the recent changes that have been made within the rooms and meals and rooms tax are very similar to some of the changes that have been made in sales and use tax. And these get at the definitions of what is the tax base, so what is taxable, also who is collecting. So operators under the general rule are traditional lodging establishments like a hotel or a bed and breakfast, or an operator might be an individual homeowner who offers a bedroom in their home for a short-term rent. So this gets at short-term rentals. A hotel does include short-term rentals. It's also inns, motels. All of these types of sleeping accommodations are listed in statute, and Vermont's Department of Taxes has adopted rules, they're called different things at the state and federal level, that list all of the different types of taxable accommodations. I did note, again, short-term rentals has been added in more explicitly due to the proliferation of short-term rentals, so those are now very explicitly laid out in statute as being taxable. So this goes into a little bit of that background. I'm sure you're all familiar with Airbnb. There wasn't a collection agreement that was entered into between Airbnb and the Vermont Department of Taxes. It was made public in 2016. There have been a lot of scrutiny on different short-term rental arrangements. So this agreement was entered into voluntarily, where Airbnb collects on behalf of all of its hosts. And Airbnb uses one rooms tax license number. There are requirements in statute for the rooms tax license number to be publicly published on any ad for rent. So Airbnb has its own. So if you look on their options for operators, you'll see always that same rooms tax number. In 2018, a definition of short-term rental was codified. It had not been in statute prior to that. It was added into the rooms tax definition of hotel to make it clear that short-term rentals are taxable. That definition has a 14-day requirement per year to be considered taxable. And again, there is a requirement now that all operators post their meals and rooms tax number, and that is to ensure that those any rentals made from a platform are being subject to tax. In the last 2 bienniums, there have also been changes made to the definition of operator. This gets at those sort of similar changes to sales tax. So online travel agents or booking agents in 2019 were added to the definitions in the meals and rooms tax chapter to make it clear that when online travel agents are charging for bookings, all of their charges are considered taxable. So that gets at the idea of this tax applies to the final sale, to what the individual consumer or purchaser is paying. The tax applies to that final amount. And this was a change that was made in other states as well, because previously the operator definitions and sort of taxable sales were not specific as to additional charges that weren't directly related to the room or the rent or the occupancy that was being taxable. So this led to a statutory change. And that was fairly nationwide, following different lawsuits in different states based on their statutes. In 2021, there was another expansion of operators, in this case, taxable meal facilitators, to make it clear that delivery services do need to collect tax on the final sale of the amount that the purchaser is actually paying. So when there's a meal delivery that's being made to a purchaser in their home, the tax applies to the full amount that the purchaser is paying, so it includes any charges, including for delivery. And that concludes my presentation on the legal background, and I'd be happy to take any other questions that you have or on any current issues that you're working on. Otherwise, I'll pass it over to Emily Byrne. Yes. So there are 2 different nonprofit exemptions, and one is for sales on premises and one is for sales off premises. And I would have to look at the statute because they have many conditions under each of them. I can get back to you on that. Yeah, so yes, there are nonprofit exemptions, but they're, I don't want to say circumscribed, but they are limited to meeting certain conditions. Thanks for the question. Great. Thank you. I'll pass it over to Emily Byrne.
Good morning. I'm Emily Byrne from the Joint Fiscal Office. I'm going to do just a high-level overview of some of the financial aspects of consumption taxes and go through the 6 principles of a high-quality tax system and how they apply to sales and use and meals and rooms taxes. So I'll kick it off with the sales tax. As Abby alluded to, it is a 6% charge on all retail sales of tangible personal property unless it's exempted. We have many exemptions in Vermont's sales and use tax. The tax expenditure report, which was published this January, estimated about $300 million in FY21 of tax expenditures. And I'll go into a little bit of detail of what those tax expenditures are exactly later in the presentation. And it's important to point out that there's a difference between an exemption and a tax on non-personal and what non-tangible personal property is. So exemption is a sort of proactive actual exclusion from the tax code. So saying that medical products, groceries, clothing, et cetera, those are not subject to the tax versus things that are not considered tangible personal property, which would not be subject to the tax by nature of item itself. In addition to the state sales and use tax, we have about 20 municipalities that have a 1% local option sales tax that is charged, and 100% of the sales and use tax is allocated to the education fund. And that was changed in 2018 when previously it was shared between the education fund and the general fund. The chart on the next slide is just a high-level overview of actual receipts from the sales tax going back to 2005. You can see up through 2018 that the blue bar is the share that went to the general fund, and the green bar is what goes to the education fund. And in FY23 through FY25, in those sort of lighter shaded bars, that is the forecast that was adopted in January for the sales and use tax. And you can see that there is a little bit of dip in FY24 that's anticipated as a result of sort of what's predicted to happen in the economy as we come off of all of the federal spending, potential sort of light touch recession that may occur. So we may lose a little bit of ground in 24, but it'll come back in 25. The next slide is just a high-level overview of the different state sales tax rates in the Northeast, just to get a sense of how we compare to our neighbors. And Vermont is kind of right in the middle, right where our companion states are. It's important to note that this is just the state level sales tax rates. It does not include local tax rates, so it's not inclusive of Vermont's local option tax, and it also doesn't include, for example, New York State has lots of county and local level sales tax, that the rate that you ultimately pay in New York is usually higher than just the state sales tax rate itself. Now I'll do a similar overview of the meals and rooms tax. The meals and rooms tax rate is 9% that's charged on the sales of prepared food in restaurants and bars. We did a similar analysis of the tax expenditure from the meals tax that's in the tax expenditure report that came out in January that outlines 8 exemptions and nearly $10 million of tax expenditures in FY 2021. There's also the 9% rooms tax on room rentals, which includes meeting rooms and hotels. And there are 6 exemptions from the rooms tax. We don't have a fiscal estimate for those because they are de minimis and difficult to outline actual costs, but there are 6 exemptions. There's also a 10% tax on alcoholic beverages served in restaurants and bars. There is a local option tax related to the meals and rooms tax. About 25 municipalities have the local option meals and rooms tax. The one sort of exception to that is Elmore only has a local option rooms tax. They don't have a local option meals tax. They're the one that's a little funky. In Burlington and Rutland, they administer their own local option tax. They had local option taxes before sort of statewide local option tax was put into place, so they're a little different. And the meals and rooms tax is split between 3 separate funds. 69% of it goes to the general fund, 25% goes to the education fund, and 6% goes to the clean water fund. This is a similar chart of just sort of historical receipts from the meals and rooms tax. You can see the changes that came in terms of how the funds are shared between the general fund, the ed fund, and the clean water fund. And you can see what happened in 21 and 20 when COVID hit, and that the meals and rooms tax took it on the chin in terms of closures and people not traveling during that time. But with COVID over, the pandemic moving to endemic, meals and rooms tax performed really well in FY22, projected to do well going forward. And those 3 gray bars, again, that's the forecast that was adopted by the Emergency Board in January. This is just another comparison of the meals and rooms tax rates for Vermont, of the Northeast states. You can see Vermont at the top with 9%. And again, we're sort of kind of right in the middle of the pack with our neighbors on the rooms tax, and a little bit on the higher end on the meals tax. And again, similarly, doesn't include any local option taxes or any local taxes that other jurisdictions may have. There are other types of consumption taxes that we're not going to go into specifically in this presentation, but just a sort of a reminder to people that there are also excise taxes on things like cigarettes and tobacco, alcohol, motor fuel, and cannabis. There are healthcare taxes that we consider consumption taxes, so taxes on providers and insurance premiums, and other taxes, fuel taxes, the solid waste franchise tax, the electric generation tax, and the solar energy capacity tax are also consumption taxes. Well, that's a legal, good. I'll let the lawyer answer that one to make sure I get it right.
So that's a great question, and there isn't any one definition of excise tax. It can sort of describe them typically. So those are generally imposed more on the wholesale side, and they can often be what are also called sin taxes, so trying to change consumer behavior. So for example, cigarette taxes, that's, there's a stamp tax, is the wholesale seller who's paying that, but the intent is to pass that on to the consumer so it's more expensive and that decreases consumption. But there isn't a clear sort of legal definition per se. I know that the cannabis tax, for example, does have that terminology in it as an excise tax, and that's more leaning towards the sort of sin tax punitive side of taxing. Sure.
All right, I will keep going on the how we apply and think about consumption taxes and the sort of 6 principles of a good quality tax system that we've thought through in previous presentations about the tax system. So as a reminder, the 6 principles themselves, so I'll walk through each of these and apply them both to the sales and use tax and the meals and rooms tax, but we have sustainability and reliability, fairness, simplicity, economic competitiveness, tax neutrality, and accountability. To start with, on the sustainability and reliability side, sales and use tax is relatively sustainable and reliable, but there are sort of economic conditions that can impact the receipts of the sales and use tax. Historically, during a recession, when people's incomes may be impacted, either through layoffs or whatever else is going in the economy, there's an impact on the sales tax. People will pull back on what they're consuming, and the sales tax may go down. On the flip side, when there is inflation and prices go up of goods that people are purchasing, we ultimately end up collecting more in sales tax as a result of the sort of increase in price that happens. There are also some important demographic considerations to take into account when you think about consumption taxes. Generally, older folks are likely to spend more money on services, which are not subject to the sales tax, versus younger people who are more likely to purchase goods, and how thinking through sort of how those demographics are playing out in Vermont and what that may do to the sales tax base in our state. And similarly, generally over the last several decades, we've seen a continued shift towards a more service-based economy than a goods-based economy, and a sort of erosion of sales tax receipts as a result. The meals and rooms tax is driven by tourism, and we sort of saw that on the chart of receipts and the drop that happened in the pandemic. It's estimated that about half of the meals and rooms tax revenue is a result of tourism. And when we think about the sustainability and the reliability of things like the meals and rooms tax, sort of asking those questions about what's going on with the ski season? Is it snowing in Boston, and are people coming up to ski and go out to dinner and stay in hotels? Thinking about how the foliage was. Did people travel to Vermont and participate in the tourism economy really impacts how sustainable and reliable that meals and rooms tax can be. The next principle is fairness. So consumption taxes are generally thought of as being regressive. So from a vertical equity perspective, younger and lower income households are more likely to spend dollars on goods, meaning that they're paying a higher percentage of their income in sales tax versus higher income folks and older folks who are more likely to purchase services. But from a horizontal equity perspective, we all pay the same 6% regardless of what our income is or our ability to pay. In order to account for the regressive nature of the sales tax, to try to make it more progressive in Vermont, this is where the exemptions come into the sales tax code. So by exempting things like clothing and groceries, which lower income folks are more likely to spend a higher percentage of their income on, by exempting them from the sales tax, they spend less of their income on sales tax by virtue of those things being exempt. But as those exemptions get adopted, simplicity of the sales tax starts to get more complicated with exemptions. So as you start to select things, you being policymakers, that are no longer exempt from the sales tax, it gets more complicated for people who have to implement the sales tax and people who have to pay the sales tax to understand what they owe sales tax on. One of the things that simplified things in Vermont was the joining of becoming a member of the Streamlined Sales Tax Agreement. Vermont joined in 2007. There are 24 total states that are part of the Streamlined Agreement. And really what that does is standardizes definitions of products across states to make it easier for merchants to charge sales tax and participate in the system. I put two definitions up on the screen just as examples. Candy is one that gets talked about a lot in terms of when something is considered candy or not, which is seemingly obvious, right? But the definition itself says that if it includes flour or doesn't require refrigeration, sort of those sorts of things, means that it's not candy, which complicates for merchants what that looks like. And there are also some complexities around the sales tax in terms of who ends up paying the sales tax. For example, if a contractor buys lumber at Home Depot, are they the final consumer, or is the person who's building the house the final consumer? And how do you ensure that if the intent is that the final consumer pay the sales tax, how do you ensure that that sales tax is passed off to that final consumer? The chart on the next page is directly from the tax department website, and I like it just because it gives a good sort of overview of an example of where there could be some complexity inherent in this decision to exempt things from the sales tax. This is this chart shows what types of clothing, what is considered clothing for the purposes of exemption from the sales tax, and what is considered taxable clothing, accessories, or equipment for the purposes of the sales tax. And the example I often point to is that a belt is exempt as clothing if it's purchased attached to a belt buckle and the rest of the belt, but a belt buckle itself, if it is not attached to an actual belt, is subject to the sales tax. So those sorts of nuances make it complicated for merchants when they are implementing the sales tax. Economic competitiveness. This often gets talked about with sales tax and cross-border concerns and having different rates in different states. Similarly, having different items that are exempt from the sales tax in different states. We're in sort of an interesting geographic situation because of New Hampshire and New Hampshire's lack of sales tax. And does that sort of change the competitiveness of merchants near the New Hampshire border if they have to charge sales tax, but across the river, there is a state that does not have a sales tax. Meals and rooms tax. We have similar rates to our neighbors, so there's less sort of issues with economic competitiveness. And with states and cities, there are varying lodging rates, but to the extent if you want to go to a specific city, there are things in that city that you're probably going to want to see, so that competitiveness in terms of the tax rate may not drive people's decisions to locate in those cities. From a tax neutrality perspective, there is likely some behavior that may be impacted by the existence of a sales and use tax. So whether or not an individual decides to buy soda, for example, because there's sales tax on that soda, so it may be more expensive than a different type of drink. Or an individual may travel to try to avoid paying sales tax. Now, that individual would be subject to the use tax per Vermont law, but people may behave differently and change where they're going to make purchases, knowing that there's sales tax somewhere or not, or a different rate. On the meals and rooms tax side, there is more tax neutrality in the meals and rooms tax code than there has been historically, as Abby pointed out, with the change related to short-term rentals and bringing some of those sort of non-hotel type businesses into the meals and rooms tax base has made it a little bit more tax neutral than it was historically. And the last piece, as I alluded to earlier in the presentation, is the tax expenditure report and how that sort of keeps policymakers accountable to what decisions they've made in terms of what to exempt from the tax code. Again, it came out in January. The Joint Fiscal Office published it every 2 years, and it tries to itemize all of those tax expenditures that are laid out in statute and provide a fiscal estimate as to what amount of tax revenue is being foregone by continuing to have those tax expenditures in the tax code. As I mentioned earlier, there's about $300 million worth of expenditures in the sales tax, about $10 million in the meals tax. And on the next slide, we have just a high-level overview of what that $300 million looks like. So the vast majority, about a third of that $300 million of tax expenditure comes from the sale of groceries and food. And the next largest is medical products, clothing and footwear, and energy purchases kind of make up that tax expenditure summary. And I think that's my last slide. And I have a question, yes?
So this is something that sort of bugs me about this, so bear with me. Typically, the word expenditure means like, I bought something. So like, why do we call this an expenditure?
Sure.
I just find the terminology confusing.
It is confusing, and it's like we have effectively spent the dollars, right? So if you're like, okay, if we have taxed everything, this is how much money we would have brought in, but we've made, there is no money changing hands, that's right. But we call it an expenditure because effectively it is like there is money changing hands. We're sort of forgoing that revenue. Does that make sense? Cool. Any other questions? Great, thank you.